Internal control and internal audit processes. So internal control comprises of the daily control and management. Daily, it's something that needs to happen continuously in respect of applications of predetermined control measures. So these are things set in place before the time, and then it's just maintained throughout. So these therefore continuous assurance that these fixed control measures and processes are being conformed to, that they point to the appointed goals that can be achieved. So in terms of internal control and management, it can be divided into 4 types. You get your preventative control. Now, preventative, exactly as the word says, it prevents certain bad things from happening. So here the accent is on the formulation of plans, procedures, programs, budget standards before the work is done, so that controls can be correctly implemented right from the start. So for instance, I put burglar proofing on the windows even though there was never before a burglary in my shop. It's preventative. The second internal control is the tracking control. So in other words, the mechanisms is put in place to track down the problems after they have risen. So afterwards, in other words, they've already broken into my place, therefore the alarm will now go off to tell me that there was a break-in. Third control is corrective or remedial. So corrective or remedial is a control mechanism in place which assists in the handling of problems. In other words, it corrects something that we've picked up is a problem. Then, therefore, we are now correcting the problem so that it doesn't happen again. So therefore now we connect the alarm system is now linked to the reaction unit, which will immediately respond when the alarm goes off. So in future, whenever the alarm goes off, the reaction unit will come out. And then there's also a directive or indicative directive control, and this is a mechanism that is put into place to prevent undesirable events from happening. So in other words, we sign stating that the property is protected by an alarm system. So this is prevent. So the first one is put into place before to ensure that it doesn't happen. Tracking is then to see once it's happened, where did it go wrong. Corrective is how do I now correct a control to put into place to correct something bad from happening again. Indicative or directive is to prevent an undesirable event from happening again. Good. So control, internal control, is designed and implemented to ensure that the goals of the organization are achieved. Now these goals, among others, is to ensure that the financial information is accurate and reliable. It also ensures that the employees adhere to the policy, the guidelines and the rules of the business. It also ensures that all employees respect and honor the norms and values of the organization. Also protects the assets of the organization. And lastly, it ensures the resources of the business are economically and effectively utilized. So internal control measurements are normally then set up by an internal auditor. So they are responsible to set up the processes and make sure that the processes runs smoothly. So internal accounting methods are checks and controls that form part of the total internal control system of the business. So these measures are not only installed to ensure that the bookkeeping is done accurately and correctly, but it also is there to protect the business against fraud and other white-collar crimes that might pop its head out. So remember, there's certain goals. What is the goals for internal control or internal accounting controls? It's there to ensure that all incomes that are earned is actually received. So in other words, all money coming in needs to be accurately and correctly recorded. It also authorizes all expenditures and correctly records the payments of those expenditures. It also makes sure that all assets are protected and that they are properly entered into the accounting records. In other words, they are also updated in their respective asset registers. Also, that all creditors and other liabilities are paid on time and that they are correctly recorded so that we actually get our discounts and do not get charged extra additional interests. They also make sure that all accounting reports are 100% correct and reliable. This is important. The internal auditor makes sure of this so that when the external auditor comes in, everything should be correctly as the standards require them to be. And that all errors and irregularities in the accounting records are identified and corrected. So very important, what is then the purpose of internal auditing? Is done to check whether the control measures are conformed to specific requirements and standards. So very important, internal auditing, make sure the controls are correct and whether it is applied correctly. It therefore comments on the manner in which measures are applied and recommended possible improvements. So very important, internal auditing is there to make sure that the controls are as it should be. Now, very important for you to realize there's a difference between internal auditing and external auditing. Internal auditing is there to make sure the controls and the internal control processes and working with the business to ensure that they've got the safest possible environment for the controlling of the business. Whereas an external auditor comes in at the end of the year to monitor and make sure and check the financial statements, the reliability of the financial statements of a business, to make sure that there was no fraud involved in setting up of the financial statements or the recording of the accounting processes. Make sure that the GAAP principles were all adhered to. Those are external independent auditors that audits the books at the end of the year according to the Companies Act. So a pre-audit investigation. As much information as possible must be gathered before an audit can be commenced. And the various aspects regarding the audit instructions must also be considered. In other words, to find out more about the general nature and circumstances of the business which is to be audited. Also, to get to know the people who are responsible for setting up and keeping of the accounting records so that they can easily be approached should any problems arise. So, audit backup evidence that consists of source documents, accounting records and any other applicable information must then be collected. It is not necessary to study every transaction, therefore we only take a test sample are taken from each division to arrive at a conclusion regarding the effectiveness of the control measures in particular divisions, and then we can comment on that. So an audit would never be done on everything, it would only be done on a sample taken from the different divisions of a business. So now, very important, an audit report is then drawn up. So the independent external auditors draws up an audit report after the audit was done. Now you need to realize that you have at the end of a financial year, you have published financial statements. In other words, each public company will need to draw up published financial statements which consist of your income statement, balance sheet and cash flow statements like we've done. Those are normal. But on top of that, you also need to have a director's report stating anything out of the ordinary that the directors feel obligated to explain further to the shareholders. Also, the audit report coming from the external independent auditor. So this audit report tells the shareholders whether they can trust or cannot trust the financial statements as drawn up by the directors. And then an integrated report. Now, an integrated report simply says how far aligned are they in terms of King Code 3, in terms of business ethics and corporate governance. So the business will simply state how far aligned are they. Have they conformed totally, or is there certain aspects still to be conformed to King 3? So my audit report, the internal audit report is set up to draw the attention to the business management to important matters of which they probably were not aware of. So the aims of the audit report are firstly to inform management of the findings of the auditors, secondly to convince management of the reliability and validity of their findings, and thirdly to persuade management to change or to improve ineffective control measurements. So these are all to do with the internal auditor's report. When an external auditor is then, when they report directly to the shareholders on the validity of the financial statements as a whole. So internal auditors are there to talk to the management, in other words to the directors of a company, where the external auditors talks to the shareholders. So there are certain components that must always be present in an audit report. The heading, the date on which the report is addressed, an introduction that spells out the role of an auditor for the management or to the shareholders. For example, that the internal control and the setting up of the accounting records are the responsibility of the management or directors, and that the auditor is only responsible for expressing a professional opinion on the domain that has been covered. A scope confirming that the audit has been conducted in accordance to general audit standards and that the opinion offered has been thoroughly researched and is credible. So these are all standard things that always goes into an audit report. Then a summary for management reflecting the findings and recommendations of the auditor considers for enough importance for the management's attention. Now very important, the opinion. So there needs to then be a paragraph which states the opinion of the auditor. So the auditor can either have a qualified opinion, an unqualified opinion, or a withheld opinion. So this is in respect of the internal checks and control processes that the business is again stated. So after they have conducted their respective audit, they will now come to a conclusion. So if the conclusion is an opinion of the auditor to be qualified, think about it, qualified tells me that there's certain things that I need to point out or show towards, which means that the report contains recommendations for changes. So these are not good, hey? There's certain problems that reared its head out, so therefore there's certain things that needs to be changed in my financial statements in respect of the statement and the information supplied. So some things were not correct. The opinion that you want is the unqualified one. In other words, were there any errors or problems to point out? No, there were none to qualify. Unqualified. So in this one, all statements and information are accepted as correct and no changes or recommendations are made. So this is the one that I want. This is the smiley face. I want an unqualified report. Then something that's even worse than a qualified is a withheld opinion. So this is when the auditor says there's so many mistakes in this financial statement, it needs to be redone completely. So he's withholding his opinion until a new set of financial statements were drawn up. So this means that the statement and information cannot be conformed to standards and therefore must be redone completely before they will give an auditor's opinion. So the last component of the audit report is then simply the name and the signature of the auditor. So if it's an independent external auditor, it needs to be signed off by a certified CA, which means that it needs to belong to the board of SAICA, South African Institute of Chartered Accountants. They are the only ones that can sign off on the public financial statements of a public company. The SAIPA, in other words, professional accountants, they can sign off on smaller private companies. They can sign off on, but the biggest companies needs to be signed by a CA, a professional CA qualified and accredited by SAICA. So an auditor should not take the signing of the report lightly, as the audit process is considered final and done with when it is signed by the auditor. Remember, as soon as that signature of the auditor is on, it means that the audit was complete and that it should then be 100% correct according to audit standards. Let's go and look at a few examples then of typical questions that you can expect in tests or exams relating to ethics and internal control of companies.